Hey guys, it's a Dividend guy coming at you with another dividend investing video. Hopefully everybody had a great green day in the market. I know it's been pretty volatile lately, but I do still wish the best for everybody, all my viewers and subscribers. Regardless of market volatility, you know that we're long-term investors here, so let's take a look at how the overall portfolio did, how the individual holdings did, and then my growth stocks as well. Today we are down $87. For the week, we are down a little over $1,000. The 1 month mark, we're down $1,600. The 3 month mark, we're down 900. For the year, we're up 278. As you can see, look at how volatile the market's been for the past year. Like, check this out. In March, this is when the virus really hit. Look at that. We were up to 22.8, almost 22.9. We dropped all the way down to 16K. Um, that V is huge. It's a huge dip in the market. Then we got all the way back up to 23, so we passed our highs here at 23K, and now we're a little bit below 21K here. So as you can tell, it's been pretty volatile for the past year. But then all time, we're up 329 since April of 2018, so a little over 2 years here in the stock market. We're up about $330 or 1.61%, so that's not too bad. And the other thing you guys have to keep in mind with the portfolio is I've been out of work for a couple of months now due to a car accident. So the value of the portfolio should be about 23K. But since I'm not working due to the car accident, my portfolio kind of leveled off. But I still want to do updates because I do get dividend income and I do reinvest that into more shares. So I'm excited about that. And a lot of people just want to see how the portfolio does on a daily basis. So I want to make sure that I keep the portfolio updates coming, even though I'm not putting my own money in. I'm just reinvesting interest from dividends. So let's take a look at the individual stocks here, starting with one of my personal favorites, a Dividend Aristocrat in Realty Income. We have 15 shares, market value of $900. Average cost is $45.38. Today we're up $228 or 33% on Realty Income. Then a Dividend Aristocrat in Altria, down pretty big with them. Nearly 100, we have 149 shares, almost 150. Average cost, our market value is $5,700. Average cost is 43 and change. 27% of the portfolio is in Altria. And all time we are down 758.45. Sorry, my dogs. Hi, Sissy. Sorry, my dog is snoring. But we also have a dividend coming in next month of $128, which next month Altria pays. So next month I'll be buying AT&T, which the fun thing is, at current prices, that will buy me 4 shares of AT&T, which is phenomenal. So that's the goal here, is to make the dividends buy some more shares and increase our payment next month. So I'm excited about that. Then we have Coca-Cola, 20 shares, close to $1,000 in market value. $51 and some change is our average cost. 4.5% of the portfolio is in Coca-Cola. We are up $12 today, down $31.50, down 3%. We do have a dividend from Coca-Cola coming in of $8.20 for our 20 shares. Then we have FRT. This is the stock that I really want to buy. I've done a lot more research into FRT, and I love the the clientele that they have for the real estate that they own. Stocks like they own Tesla properties, they own Starbucks properties, Best Buy. They own a lot of very good clientele, just like Realty Income. I am a bit more bullish on Realty Income, but I do like where Federal Realty puts their outlets, and I like the diversification of the tenants, and I like the amount of people that they are putting surrounding their real estate with, because they do a very good job. They're very strategic at how they place their malls and where they make it like a central hub, and the income around that, the placement is very, very good. So I'm a little bit more bullish on Realty Income, but FRT is still up there. And I only have 1 share, market value 73.80. We're down big on this one, but it's only a share. So this is what I like to do when I'm initiating a position, or when I have, say, cash left over, or for dividends, I will put it towards 1 share of another company. So like, let's say I probably bought Altria the last time I got dividends, but I probably got paid by Altria and didn't have enough cash or wanted to initiate a position, so I bought one share. And the reason that I did that is because I didn't have enough for two at the time. So now I can cost down average easily with FRT. So if I buy another share or buy two shares, my average cost goes down by $40 a share, but I keep that dividend of $1.05. So that's why I try to be very strategic. And usually when I initiate a position, I do it in bulk. But if I have, say, if I bought a bunch of Altria and I wanted to diversify a little bit, I'll buy a share of, say, like FRT or like Pepsi maybe, or something that pays the same month, so I get a better dividend payment the following month. But then I can easily get a cost on average opportunity with fluctuation, and I don't have to worry about having to buy 20 shares. So, like for example, with Altria, I would have to buy a significant amount of stock to to really bump down that cost down average because I have so many shares. But with FRT, I can easily do that um, because of the low share count, and because of that I can cost down average and my yield gets locked in at a much higher price. But with FRT I am down about $40 or 34.9%, but I'm not worried about it. It's a dividend king, and like I said, a very small position, specific and strategic, because that way I can cost down average very easily on that position. Then we have Lowe's, one of my rocket stocks. We have two shares, 320 is market value. Average cost is $100.86. 1.5% of the portfolio is in Lowe's. We are up $120 or almost 60% on Lowe's. And they are a dividend king and a quality company that I would love to own more of. I just don't want to own more of them at that big of an up cost. It's $60 a share that I'd have to go up in my cost basis, and I don't want to do that. So Lowe's is one of those that I'm just going to buy and hold forever. If it goes back down to around $100 a share or even $110 a share, I would happily buy it. But as you can tell, I bought it around there, about right about there, and it took off like a rocket. So I'm not touching Lowe's for a while. But it is one of my favorites. It's a quality dividend king, and they did a 9% dividend increase. So if I base it off increases, Lowe's is one of my best performers, but simply because of how high the stock has gone up, I will not be purchasing more. But I love the company, and if it ever gets down to that cost again, I will be buying more. But it's like that with three of the stocks in the portfolio. Lowe's, AbbVie, and Target are all like that, where they're quality companies. I would love to buy more. They're phenomenal dividend payers. They have great dividend growth history. I just don't want to go up that high on my cost basis on those positions. Next, we have the complete opposite of Lowe's, which is AT&T. This is in my top 5 stocks of all time. This is one of the first stocks that I ever purchased. This is one of the stocks that I'm always talking about. I'm always super excited about. And the reason is because it's been down so much. So as you can see, even today it was near $30 or near $29, and now it's down to 20.55. But look at how high it was December of last year. So I bought it when I started investing in 2018 at some point, which was around $30. So I bought it around here. And as you can see, it's had a significant rise due to Elliott Partners, I think is who bought shares and was trying to get the board to clean up its businesses by selling DirecTV, which I'm a fan of that. But as you can tell, it dropped off a cliff. And this is where I want to buy it now, because now it's even lower. And that's a phenomenal cost basis. And the reason I say that is because if you look at my average cost on AT&T, it's 30.93. So I have a great cost down average opportunity after nearly 2 years of it being above my cost basis. I have a significant opportunity here so far in 2020 to cost on average, but I can't do that currently. But I will be doing dividend reinvesting into the stock. So I have 71 shares, $2,000 in market value, 30.93 is our average cost. 9.7% of the portfolio is in AT&T. That will be going up because this is going to be one of my gold stocks. And I'm down 7% on it. But again, I would rather be down on AT&T significantly than be up on AT&T. Love the business, love the consistent cash flows that this company produces due to the telecom environment and the way the business operates. I love that I'm down on it because it's a great cost on average opportunity on a quality dividend aristocrat. Then we have AbbVie. This is the same story as Lowe's. I bought them during an acquisition and they ran up like a rocket. So I haven't bought any. But I would love to buy more of AbbVie. So we have 60 shares. I bought them crazy big in bulk. $5,300 of market value. Average cost is $72.22. That's not going to change unless it goes lower, but it hasn't for a while. 25.5% of the portfolio is in AbbVie. Again, that's only so big because I saw a great opportunity to buy significantly lower than the historical average due to the acquisition, and I bought a bunch when I bought it when it was low. And as you can tell, it hasn't really gone that low since. So I'm up almost about $980, up 22.6% on AbbVie. And again, guys, check this out. Um, I bought it here. As you can tell, that is near. It's not a 5-year low, but it's as low as the company has been since 2017. So that's the lowest it's been in like 3 years, or even a year. Um, so we've had a couple of significant drops. I didn't see that one at first, sorry, but as you can tell, even there, I still got a great value on that company, and it's ran up significantly, and it's way low from its high, so it would be a phenomenal opportunity. Even here at $88, compared to 115, you have almost at least $20, almost $30 of upside there. So, great company. Just one of those that I bought and it ran up. Then we have J&J, a dividend king. We have 2 shares. Market value is about $290. $135.79 is our average cost. So I'm not buying any J&J right now. It's a little higher than my cost basis. 1.4% of the portfolio is in J&J, down $1.78 today, up 16 dollars, up 6.2% on J&J. Another quality king in 3M. We have 2 shares, $325 of market value. Average cost is $147 and some change. 1.5% of the portfolio is in 3M. We're up $30 on this position, up 10.23% on 3M. Then we have another quality dividend king. So we have 3 kings right away for the set of months. In a king in Target quality company here. 10 shares, $1,500 in market value. Average cost is $87.68. 7.38% of the portfolio is in Target. Today we're up $36. Total we're up $658, up 75% on Target. That's insane. But again, just like I said with Lowe's and with AbbVie, I bought this and it took off. Like, look at that. I'm not going up. So 97, 107, 117, 127, 137, 147. So almost over $60 a share we are up on this company, which that explains the $600. But like, think about that, $60 a share. I want to go back and punch myself in the mouth for not buying more Target stock. I could say that about AbbVie and Lowe's as well. But here's the thing, though: when I bought Target, I didn't realize how far it had run up. Um, I mean, its 52-week high is 156. So this is like an unprecedented level for the stock for this year at least. Um, so it just took off like a rocket ship. And this is one of those that I bought it because it was a king, because I wanted the consistent cash flows. Like I liked the financials. I liked the financials of the company, but I could only buy 10 shares at the time. But the thing is, I bought companies like J&J. I bought companies like 3M, which again, king status, great companies. But that money could have gotten me crazy good upside in Target. $300 or almost a grand could have bought me 10 more shares. I could have bought 20 shares and been up $120 a share. See what I mean? Or $120 instead of 60, because I'd double my share count. But again, we live and we learn as investors, and I'm just happy that I bought it at all. Um, but again, guys, that's time in the market is more important than timing the market. It's very different, because if I tried to time the market, I'd be selling Target right now. But the consistent dividend cash flow I get from the company, I'm gonna have to pay less taxes on if I versus me selling a stock. So I'd rather just hold it, have the money tied up there, get the dividend income, and take advantage of other opportunities that I see. Which this is one of them, being Walgreens. We have 6 shares, 214 for our market value. Average cost is a little below $40, so a good cost on average opportunity, about $5 a share there. 1% of the portfolio is in Walgreens. They are very close to Dividend King status. I believe 46 or 47 years of dividend growth. So they should be a Dividend King by the time I hit 30 years old. So one of those that I'm just going to buy, wait till it hits King status and pour a lot more money into. We are down $25 total, down 10%. Not worried about it though. They have consistent cash flows even through the pandemic. They're doing better than a lot of other companies, and they are close to King status, so I'm happy to hold. Then we have ExxonMobil. A lot of people are bag on ExxonMobil. They're worried about it. I'm not super worried about it. One of the reasons people are worried about it is our dependency on oil is starting to decline. But one of the reasons why I'm not super worried is because we're not moving towards green energy as fast as people think. We're more dependent on gas, and electric vehicles aren't as popular as people are projecting. I hope they become more popular, but even if they do kind of take over, I'm not super worried about ExxonMobil. And even if carbon emissions get lowered in the United States, that does not mean that it's going to happen everywhere. And people are still going to consume oil in China and other countries which have bigger populations and use more than the US anyway. So I'm not super worried about it. Even the price of oil, I know a lot of people talked about that too. One of the reasons that doesn't bother me is because they've paid consistent dividends through all the ups and downs of oil. And the reason I bought ExxonMobil and thought about buying Chevron, the reason I was in oil at all is due to that volatility. I want that volatility because if you look at some of the kings that I own, they don't fluctuate very much. Like J&J might go from like 90 to like 130, which is a pretty decent spread. But the thing is, it still has consistency, right? Where ExxonMobil is trading at 35, but its 52-week high is 73. So you have a nearly $40 upside on ExxonMobil, where it'd be harder to get that in something like a J&J or Target, right? So I specifically bought ExxonMobil because it's a cash cow, and its dividend history is phenomenal. Its dividend growth rate is great, and I bought it specifically for that volatility because I want to take advantage of it, which is one of the reasons why I'm irritated that I'm not working currently because I'd be pouring more money into ExxonMobil because it's a phenomenal buy for me. I go down $20, nearly $20 a share on this and lock in nearly an 8% yield on, or above an 8% yield on ExxonMobil. So I wish I could buy more. But for everybody that's worried, I'm not personally. I actually like the volatility because it means I can get it at a significant discount. Then we have Aflac. This is my gold stock. I am big on insurance, and I like the float that they have and the cash flow that they bring in. I have one share, 36.37 our market value. Average cost is 35.75. 0.17% of the portfolio is in Aflac. We're up 62 cents all time. Nothing too significant, but I do like the business model. I do like the cash flows, and it is a dividend aristocrat as well. And the reason why I'm super big on Aflac is the payout ratio. You see different ones on different sites. Some of them say 28%, some of them say 31%. But a 20 to 30%, like a 25 to 30% payout ratio is healthy. That's very good. In fact, that's pretty rare for a company like this. Companies like Pepsi are close to a 90%. I know J&J is probably, I think that's like a 75%. So most dividend aristocrats or kings sit between like a 50 to 70. And usually that's the sweet spot. Aflac's at a 30%. They've already increased the dividend for I think 36 or 37 years consecutively. Um, and I know they only did like a cent raise, but it doesn't matter. They could like triple the dividend right now. Because if they're at 30%, if they triple, well, if they could at least double the dividend right now and be still be as healthy as something like a J&J um, or 3M or another dividend king. So they have enough cash flow to significantly increase the dividend and aggressively grow the dividend over the course of my lifetime and still be at the same level as companies that have done it for just as long or even shorter periods of time. Most of the time, companies, like I said, they go for 40 to 60%. And as they grow more, of course, the payout ratio goes up higher. But the issue you run into is the inconsistent cash flow. So I like the business model, and I like how low the payout ratio is. And if you guys, um, are looking for a quality company, Aflac should be on the list because I love them. Um, but anyways, I love them for the low payout ratio and the potential dividend growth that they have for the future. But that finishes out my actual portfolio. But let's take a look on whether I'd buy or what stocks I would buy. So I added Leggett and Platt again. I'm iffy on this one because it takes about 100 shares, which would be about $4,100 right now, to be dividend efficient in the stock. But I do like it at $41 though. It has just enough for me to buy it, so I would be buying shares of that. Cisco at 64, definitely buying that. Genuine Parts 96, I'm not touching it. PepsiCo at 132, I'm not buying it. Well, yeah, it's just enough. I want $15 of upside, so that's just enough for me to buy shares of Pepsi. I go for $15 of upside in the stock at least. Kimberly Clark at 46, just enough for me to buy it there. Colgate at 76, I would be buying that too. Starbucks at 83, almost 84, not enough upside. Procter & Gamble at 137, not even close. Essex Property Group is my favorite apartment REIT. They are a dividend aristocrat. They pay a monster good dividend, and they have crazy good upside here. At 334, you have $130 of upside in the stock, plus a monster dividend in 25 years of consecutive growth. For me, this is one of the highlight buys, and it has been for over a year. I've just been focused on other companies, specifically AT&T and AbbVie. I thought were better values, but if I had the extra cash flow right now, I'd be pouring it into Essex Property Trust. So definitely buying that. I added U.S. Bank because it's my personal bank. I did get bit by Wells Fargo, so I'm very tentative to add a bank. But I do like the 42-cent dividend here at $35 a share. I would only need I did the math earlier, but it's not crazy bad. It's like 4,500 I think to be dividend efficient in the stock, which would just be a consistent year of buying it for me. And I personally use US Bank, so and I looked into the financials and I like them a lot better than I liked Wells Fargo's. Next, we have Black Hills. They are my utility play, and at 53, I already know what to buy. Mickey D's. This is one of my favorite companies. I just haven't bought it yet because how long it would take to be dividend efficient in the company. I love the business model, but I would not be buying it. It's only $10 of upside. Next, the growth stocks. Apple, definitely a buy for me. $27 of upside. Disney at 127, about 20, $30, almost $30 of upside. $24 of upside. Definitely buying it there. Microsoft at 207, buying it there. Facebook at 254, buying it there. $50 of upside there on Facebook. Costco at 348, just enough, but I want it more towards the 340 mark. But I would buy it. I like Costco, and I love the loyalty and the the brand and the consumer brands the brands that they have in the actual store that they produce themselves. Love those. Um, that's one of the reasons why Buffett's so bullish. They actually rival like Kraft Heinz um, with their in-store brands. So I definitely want some Costco in the portfolio as well. But all that being said, guys, a lot of buys here. My favorite stocks currently that I want to buy um, are Coca-Cola, FRT, AT&T, and Walgreens in the actual portfolio. I would say ExxonMobil, but I'm very heavy in Exxon already, and I want to diversify a little bit more. Stocks that I really want to add into my current portfolio for the watch list, like my favorites for the months here, would be PepsiCo, would be SX Property, and Black Hills. And then for the growth, if I had to pick one that I'm buying this month, Disney. I gotta get me some Disney. Love it. I regret selling it, but I had my reasons. They cut the dividend, and I am a primary growth investor. But the goal is to have 8 stocks paying me every month, and then add realty income for a monthly payment for 25 stocks that pay me dividends, and then I also wanted 5 growth stocks, which Apple pays a dividend, Microsoft pays a dividend, and Costco pays a dividend. Disney, I believe, will reinstate it soon. But for right now, the only growth um, companies that don't pay a dividend are Disney and Costco. And out of these, my favorite pick is Disney. So that's where my money would be going if I had any to deploy on top of my gold stocks. So in the portfolio, I'm focused on Coca-Cola, AT&T, and Aflac. But any extra cash would go to deals that I see, which the stocks I just listed are the ones that I'd be focused on with anything over my original $1,000 a month. But anyways, guys, with that being said, I will see you guys in the next Robinhood portfolio update. Remember to hit the subscribe button and hit the bell notification on my channel, That Dividend Guy, because I post a lot of content. I did take a week off, but I'm back into the swing of things now. I did a dividend update on Microsoft and Texas Instruments. I did a portfolio update. I will be doing portfolio updates Monday through Friday, and I will try to sprinkle in a bit more content so you guys have more videos to watch. And I have a lot of free time on my hands, so I'm going to try to get more content out to you guys. But with that being said, I'll see you guys in the next Robinhood investing video. Um, I'm super, super excited. But I'll see you guys tomorrow, all right? Take care.